I want to talk U.S. markets and equities in just a moment, but to the extent that we should be focused, if we aren't already, on what's happening in Europe when it comes to Credit Suisse, and when we start to think about what's going to happen to the oil complex when you factor in the situation between Russia and OPEC, what do you think it portends for the week, Megan, in terms of equities?
So in regards to Credit Suisse, it's a very early story. We don't have a ton of information yet. Whenever there is this time where we do a lot of speculation, that can create panic. We understand that. We saw that back in 2007 and 2008. And even though that was more than a decade ago, I think people still have some, that at the forefront of their heads. So there'll be a lot of nervousness in the market regarding that. I don't think Credit Suisse can wait until the end of October to address this. Yep. And then in regards to oil, anything that causes oil prices to go higher, that's a bigger risk here to the inflation story. And when we're talking about U.S. equity markets and even global equity markets, we've got to get that inflation under control. That's the only way we can see, a sustainable end of this bear market.
Kathryn, you want to be in this market? Or you want to be in cash right now?
Cash is wonderful to have right now. The question, I think, Andrew, is when to deploy it more than should we liquidate portfolios at this point. Having cash has been a great thing over the course of the past couple of months, right? So the question is, when do you start looking at British equities? When do you start looking at European equities? Do you rotate now into value? So I like to be defensive. I've been telling our clients at Bulltick for some time to be in defensive sectors. Right now, I think looking at the duration curve looks enticing in the high grade market, in fixed income and in treasuries. If treasuries in the 10-year space hit 4, I think it's time to start accumulating in the back end there, 10 years and later, as a hedge to risk assets. So be defensive, have the staples and have the utilities and have the energy, I think, stocks going into next year. Megan's right. I think that inflation becomes more of a demand destroying scenario going into 2023. So expect recession, have some cash, have some gold, and certainly be defensive. And with regard to Credit Suisse, as a Bear Stearns alum, it foretells negatively when you have this type of action. And it is intimidating because we all remember what happened back then. But as Megan said, it's still early to tell. I do agree with her. I think that Credit Suisse has to come sooner rather than...
Kathryn, as a Bear alumnus, then help us with this. Typically, we tell our viewers, and the sort of general consensus is that when things look bad, hang on tight, but don't sell. 2008 was maybe anomalous in that case because you probably should have. I'm not saying this is 2008, but I'm curious what you would tell people.
I just remember, Andrew, Ace Greenberg coming out the day before Bear went under saying the Bear was well capitalized and we were great. And I went to NYU Stern. At nighttime, I went in front of 300 to 500 people and said, we're strong, we're capitalized, we're going to weather through this. The next day, Bear was gone. So I'm the wrong person to ask about this. But certainly, I agree with you. Don't liquidate now when, we're talking very volatile markets. We don't know where the Fed's going to go. Historically, when the Fed does pivot, you get a rally in equity markets. My suspicion is next year we're going to see that.
And let me ask you then, Megan, on that point about the Fed and whether they're going to ease up. I think that's the other underlying question here, and maybe why you're even seeing some green on the screen. If you add OPEC and Russia together, you throw Credit Suisse into the mix. At some point, does the Fed wake up in the morning and say, you know what, maybe we've done our work here, and in fact, we're making it worse?
At some point, I think they will, but I don't think that's anytime soon. They've made it very clear. They've been very hawkish in their rhetoric, and I think if they turned now very quickly because of what is speculative news or coming out of Credit Suisse, this is not something that I think that they want to do. The transparency in the Federal Reserve is extremely important to actually have the chance of having a soft landing here. They're going to go 75 on the next meeting. The market's pricing in 50 in December. Where I think the market is wrong is that they're pricing in for Fed rate cuts in the second half of next year. And they've told us they're not going to do that. And the market continues to factor that in. So I think the long end of the yield curve still has room to rise from here at a 375, 378 where we are this morning. I still think that's too low. I think that will break above 4% in the long end of the curve.
Shepard Smith here. Thanks for watching CNBC on YouTube.